All right, I think we'll kick off. Welcome to this webinar organised by CASA on bridging demand and supply of private investment capital for SMEs. The Commercial Agriculture for Smallholders and Agribusiness programme, called CASA, aims to make the commercial and development case for investing in agribusiness that sources produce from smallholders. CASA bridges evidence gaps to ensure that investors and policymakers have access to the right information and people to make inclusive agribusiness models succeed. CASA aims to attract more investment into the sector, boosting economic growth and raising demand for smallholder produce. It does this through three key areas of work: supporting market access, investor technical assistance, and research for investors and policymakers. It was set up by the UK's DFID, now the Foreign, Commonwealth and Development Office. So as part of CASA's efforts to shape the debate on smallholder agriculture while creating networking opportunities, CASA organises global, regional and national events bringing together investors and investment support stakeholders. This is the third of the three sessions that form CASA's first Global Agribusiness Investor Summit. Each of the sessions focuses on one evidence report commissioned by the CASA programme and aiming to address existing evidence gaps. These pieces of research are all launched today and they're all available on the CASA website at casaprogramme.com, and you'll also see a link to the research on the chat function. The other two sessions we had earlier today, ICTs for improving investment readiness of small and medium agribusinesses, and the effectiveness of agribusiness incubation in emerging markets, will be available also on the CASA website. They're recorded, as will this one be when the recording is ready. So do check those out. The structure of this session, first of all, we're going to have a presentation of the research and the key findings by the lead researcher, Thomas Jane. Then he'll take questions, so please post questions in the chat. Then we'll follow by presentations from the panelists. I'll introduce each one briefly and they'll have a few minutes to provide details from their own experience. They've been selected as panelists because of their deep expertise in investment and their insights on the topic of discussion. Please send your questions through posting them on the chat, and the organisers will pick those up. We'll then put them to the panelists after their presentations. So as I say, the session will be recorded and made available through the CASA website. So I'd like to introduce first of all Thomas Jane, who has been the lead researcher for this piece of work. Over to you, Thomas.
Great. Thank you, Alice, and good morning, good afternoon, as the case may be, to all of you who are listening. Tim and Julia, nice to see you guys again too. So good. So as Alice had just mentioned, this study was organized by the CASA group, Commercial Agriculture for Smallholder, Commercial Agribusiness for Smallholder Agriculture. And it was really motivated by this apparent contradiction. The contradiction is that suppliers of private capital report a lack of investable opportunities in Africa, but at the same time, demanders of capital are saying that they can't find needed private equity to expand their businesses. So this study was really motivated by the need to reconcile this apparent contradiction and to chart the way forward and try to help give guidance to both impact investors as well as to African governments and even DFIs to promote private investment to African agriculture. Tim and Julia were two of about 9 Delphi experts who were interviewed by our team. Some of the other Delphi experts who were interviewed include the president of IFAD, the president of the African Development Bank, some high-level people in the CDC, Embrapa, so a very wide range of DFIs, impact investors, and people on the ground working to promote private agribusiness. Okay, so I'm going to, just in the interest of time, I'm going to just focus on 3 key messages. And message number one is that we concluded that there is no shortage of global private capital that is able and willing to invest in Africa. Here's a couple of facts. The real assets under management globally that are, and by real assets, we're talking about agriculture, forestry, land, agribusiness investments, real assets under management, 12 trillion in 2018, 12 trillion US dollars. And this is expected to rise to 18 trillion over the next couple of years. So it's growing. But food and agriculture, global assets under management, are only 87 billion. Now, 87 billion seems like a lot of money, but that is about 1% or less than 1% of all of the real assets under management globally. Now, of this 87 billion, 4% of that actually is invested in Africa. So when you do the numbers, you find that about 0.3 of 1% of all global assets under management are in African agriculture and agribusiness, 0.3 of 1%. Now let's say, just a thought experiment, let's say that 1% of all of those global assets under management, just 1%, were reallocated from their current portfolio into African agribusiness. What would that represent in terms of an inflow of private investment into Africa? Well, it would represent an 11-fold increase in the amount of private capital moving into Africa. So it takes just a very small amount of the global real assets under management repositioned to have a flood of new investment coming into African agriculture. So in other words, there's massive potential. Lots of private investment that is basically perched on the sidelines, waiting to pour into Africa when the conditions become right. So that's message number one. Message number two, which really is a question that flows from the first point, why isn't there more global private capital flowing into African agriculture? And the results that we got from the Delphi interviewees were varied, but they almost all pointed around a couple of key points: low perceived return on investment and high risk. Now, there are some small number of firms that were seen to be, bankable investments, but by and large, there's a paucity of, opportunities that have that meet the hurdle rate for global private capital and very high risks. So just a few examples that were pointed out: unpredictable trade policies, frequent export bans, ad hoc tariffs being applied, difficulties in repatriating money, marketing boards controlling prices in a quite unpredictable way, barriers to entry into seeds distribution or even seed certification, transparency in tendering to participate in subsidy programs, for example, the lack of credit bureaus so that people can assess the risks of investing in particular firms and what their debt already might be. Revoking licenses to operate. This happens in quite a few places still. So when you kind of run down the litany, what's the risk that you may make an investment and then you kind of lose your permit to operate? So many people, many of the Delphi interviewees talked about the need for compelling national agri-food system development plans. Now we have the CAADP, we have other kinds of the high fives, the African Development Bank, but the points were raised that we need to go beyond aspirational development plans that sort of talk about what the goals are, but actually talk about laying out benchmarks, Gantt charts for how and when to achieve these targets, who's responsible, who's accountable for achieving these targets, and then implementation modalities. When will the policies and programs be implemented by African governments to provide sort of the enabling environment that would promote the kind of private investment that we're all looking for. So that's message number 2. The final message number 3, before I end here and hand over, will be there's also a contradiction here. So, much has been made of this massive investment in agri-food systems in Africa. You may have seen some of the research that's been done at Michigan State University, talking about an 800% increase in agri-SMEs in Africa. So lots of private equity that's being put up by African small, medium, and mostly small and medium enterprises within African food systems, basically providing their own equity for these things. So on this point, I would think it would behoove us to talk about 3 categories of these agri-SMEs. The first one are the elephants. And the elephants are the large players, the very small number of players who have been in the game for a long time. Olam, export traders, these kind of groups. Then we have the gazelles, who are small companies, but they're productive and they have potential for expansion and scaling up. These are the targets of a lot of impact investors in Africa, but unfortunately there aren't very many of them. And the goal here is how to grow them and expand their numbers. And then we have the majority of SME agri SMEs who are basically survival entrepreneurs. They may be 1 or 2 person businesses with hardly any capital to speak of. They're barely making it. And once there is sort of significant value chain upgrading that does take place, most of those survival entrepreneurs will be basically moving out into other things and becoming employees of the gazelles. So I think that we need to not sort of be blighted by the fact that even though there is a lot of small and medium scale investment in African food systems, a lot of this is survival kind of entrepreneurs, and that the real goal here is to identify the gazelles and to expand their numbers, and these are the kind of activities that I know Tim and Julia are both involved in. So Alice, let me stop there, and thank you very much again for allowing us to have this session here, and thanks to Agra for this. Thank you.
Thank you very much, Tom. That was really, really interesting. And just a quick question to you, because we'll ask you a couple of questions before you have to head off, and then we're going to start on the panel after. But one question that occurs to me is, what role do the elephants have in supporting the gazelles and the others? Because it feels like that's something which there's an ecosystem there where there could be some sort of collaboration and some support investment, perhaps from the elephants into the lower down the food chain, if you like.
That's a very good point, and I totally agree. And many of the elephants are really playing that role already, and seeking to play a wider role. So very, very good point, Alice.
Yeah. And a question that's come in from Rashida Sykes. Any recommendations for small individual investors seeking opportunities in African agricultural businesses? Small individual investors. Yeah.
Tim, I think Tim and Julia are better placed to speak to that.
Perfect. We'll pick that up with them.
I would say, Alice, that there are a number of suggestions or proposals that speak to that very question that are in section 4 of the report. So if Rashida's in a position to download that, section 4 should have a lot of
fantastic. A very, very good opportunity to plug the report, and please do, everybody that's on the webinar, please do take a look at it in depth. Tom, thank you very much indeed, and please do stay with us while you can. I want to move to the panelists and welcome them. So I'll introduce each one briefly, and then we'll have a few minutes to ask Q&A of them at the end. The first I'd like to call on is Julia Wakeling. Julia oversees the management and environmental, social and governance risks and the monitoring and reporting of the impact of Silver Street Capital's investments. Silver Street Capital is a UK-based investment advisor managing African agricultural funds. Its objectives are to achieve a positive long-term social impact while making attractive returns for investors. Silverlands One is the largest sub-Saharan African agricultural fund. It invests across the agricultural value chain, including the seed sector, primary production, processing, storage and trading in 6 countries in southern and eastern Africa. Now both Julia and Tim are being asked to address in particular some questions that came from the report. What can the following actors do concretely to increase the flow of private investment to agri-SMEs in Africa? African governments, DFIs, impact investors, foundations and development partners, agri-SMEs themselves. Secondly, should development partners and foundations try to promote private investment to agri-SMEs in Africa by focusing more directly on providing services to smallholder farmers or to building the institutional foundations of the food system? And then finally, are you generally bullish or bearish about the likelihood of achieving much greater private investment in agri-SMEs in Africa over the next 5 to 10 years, and why do you take your position? So Julia, you're the first off to answer that very large set of questions, but if you could do your best to cover the ground on those questions, that would be great. Thank you.
Cool, thank you very much. Can you hear me?
Yes.
And yeah, I will try and do that in the right time. So yes, thank you very much for having me. Silver Street, as you said, is the investment advisor to the Silverlands funds. We invest with social impact across sub-Saharan Africa. We have businesses in 8 countries and funding from institutional investors in and DFIs across Europe and the US. So very briefly, our investment strategy is to build commercial hubs that integrate with smallholder farmers into the business model. And that way the business can scale and both the business and the smallholder can be profitable for the long term. That is about the shortest description of Silver Street I've ever given, but you can read more about us on our Silver Street Capital website. Okay, so to answer your question, so the first one is what can the following do to increase private investment? So on governments, infrastructure, critical to doing anything, road networks, electricity, phone networks, healthcare facilities, schools, universities. You just need all of that in order to begin operating. Having an easy operating landscape, so for example, secure property rights and efficient processing times for things like ESIAs, water rights, visas. Sometimes, I mean, countries are quite determined to ensure that people from within the countries are hired. But I mean, if you take an example, like you wouldn't start a heart surgery without a heart surgeon, and maybe you don't have a heart surgeon in the country. So you need to bring in some external expertise sometimes. There's in terms of operating landscapes, so governments can provide a transparent, consistent market for agricultural commodities by fixing crop prices or putting in export bans that can really destabilize the market, and often the smallholder farmers are the ones that come off worst. And so even though sometimes those export bans are to try and increase prices, it sometimes doesn't work that way. Governments can also provide positive facilitation, so for example, like tax incentives or tax benefits. So Tom was just talking about having like a plan in place and then having a tax incentive for businesses that meet that plan, that fit into that plan. And lastly on governments is providing an ethical environment. Private investors simply can't abide by any bribery and corruption, and so that's just not possible. All right, next is DFIs. So DFIs can provide long-term patient capital, with the long-term and patient being the operative. Everything in ag takes quite a long time, and so investment horizons in ag need to be longer. DFIs have like quite a high-level overview and can provide advice and knowledge sharing both to GPs and portfolio companies, and also training. So from an ESG perspective, CDC provide really good training that both GPs and portfolio companies can attend. DFIs can also increase their Ag and Africa buckets, which, as Tom was just saying, would make a radical improvement into the amount of private capital that's available. Next is impact investors. So what we do, and what we obviously think is a pretty good model, is building smallholder farmers into our investments. So we build the commercial hubs, we identify value chains, we try and fix those value chains and integrate the smallholder farmers. What this needs is a really good understanding of geographies and value chains. And not all value chains are the same in different countries. And so, for example, like poultry in South Africa is about as different as you could possibly get from poultry in Tanzania. And you can't think of them as the same. And to do this, you need the expertise of African agriculture on your investment team. And so maybe you don't want to be like an Africa-wide or sub-Saharan Africa-wide. Maybe you want to just focus on one area in Africa if you're gonna be the specialist there. Another idea is that some crops are really good for smallholder production, but some work much better on a commercial scale or with commercial expertise. And in that case, you can build joint ventures with communities. And so you provide, as the expert, you provide some of the management advice, and then partner with the joint venture, with the community, with the idea that the community takes over the business in time. Next is, what can foundations do? So foundations can, one thing is that they can provide very useful grant funding that can facilitate training. We've seen this in like a targeted training grant that can then scale the business much faster than it would have without that funding. So for example, in poultry in Tanzania, we received a $3.6 million grant from the World Poultry Foundation that has enabled the business to reach many more poultry farmers than it would have without the grant. And so it's just gone a lot faster than it would have. But the whole model was already in place. And then agri-SMEs. So thinking of smallholders in particular, well, you can beware of debt. Don't get yourself into debt. Pay back your loans and develop a credit rating. So start small and grow slowly. Work as communities. So there's savings and internal lending, internal loans communities that have worked quite well in some areas. And essentially just like be ethical and build long-term ethical partnerships with other stakeholders. So second question is, should funders focus more on direct to smallholders or on institutions in the food systems? And I'd say both, because they're at different parts of the value chain, and so you need both for the value chain to function. And so you absolutely need direct services to smallholders. And so smallholders need training. They need knowledge and skills from somewhere, and they at the bottom of the poorest of the poor, and so they're unlikely to get it by self-funding. And so it would be from grant-funded extension services run by businesses or from NGOs. And we really need to think holistically about smallholders. So to be successful in agriculture, the smallholders need more than just agriculture. They need schools and healthcare and roads and local infrastructure. They need access to inputs on time. They can't be like spending days traveling to try and get poor healthcare when in the middle of the planting season. And so it's not just training in best agricultural techniques, but also financial planning, maybe family planning, how to best take care of themselves, and their children in terms of nutrition, healthcare, education. And then the second part of that was building institutional foundations in food systems. So absolutely, a food system, a value chain has to be based on strong businesses, and they need a strong business at their core. Everyone has to be profitable in order for the value chain to function, with smallholders in different places. And your last question is, am I bullish or bearish about the future? So it all depends on the geography, right? And some environments are very difficult operating environments, and cultures are hard to change, and so I don't know, I'm slightly more skeptical in those areas, but some are pretty stable and good spaces. And with growing populations in Africa, there's increased need for food production, and with that comes great opportunity for successful investments with really good returns. So in some places, yeah, pretty positive.
Julia, thank you very much. Remarkable. You've managed to pack so much insight into just 7 minutes. So I appreciate that very much indeed. And we'll come back to you for questions. There are questions coming in. Please, anybody who wants to post a question, continue them coming in on the chat, and we'll pick them up and pose them to Julia and Tim at the end of their 2 presentations. So thank you for that. And moving on to Tim Strong, who is the head of agriculture finance at Opportunity International. Opportunity International provides microfinance loans, savings, insurance and training to over 14.3 million people who are working their way out of poverty in the developing world. Clients in 24 countries use these financial services to start or expand a business, provide for their families, create jobs for their neighbours and build a safety net for the future. Their vision is a world in which all people have the opportunity to achieve a life free from poverty with dignity and purpose. So Tim's also been asked to address the same questions that Julia did, and again has to pack much into a very short space of time, but look forward to your insights too, Tim. Over to you.
Thank you, Alice, and greetings to everyone from Lilongwe, Malawi. I'm going to take a slightly different approach and more demonstrate case studies and use case of how certain barriers have been overcome in terms of financing agribusinesses across the continent. So starting with the second question on agri-SMEs or smallholder farmers. In 2017, our portfolio had the privilege of running digital surveys of 23,000 smallholder farmer clients. Through investments in strengthening the presence of mobile phones, we were able to directly ask these clients questions on their productivity, yield, income, and my personal favorite question, what are their perceived risks in increasing their investments in their own farms? In response to the last question, 43.16% wrote back to us saying that a lack of financing was their limiting factor. Of course, I'm sure you can imagine our team, which focuses on access to finance for smallholder farmers, started jumping up and down, overjoyed that our program was on the right track. But then, there's always a then, right? More responses kept coming in, and 43.64%, so a margin slightly higher than financing, farmers began reporting that lack of liquidity and acumen at the SME agribusiness level. The cooperatives, microenterprises, small businesses that provide them with their seeds and inputs, that buy their raw produce and process cocoa pods and coffee cherries and tomatoes, were not meeting their demand for support. And that until these agribusinesses were strengthened, they would continue to be unsure about how much time, effort, money they should invest in their own farms. So from an institutional mission alignment and last mile farmer use case, it became clear to our program that agribusiness SME financing and technical assistance is absolutely critical. And this was the launch of our agribusiness portfolio, which has now supported over 15,000 small rural agribusinesses and represents now 1/3 of our total portfolio by value. So a lot of sessions today, a lot of presentations, a lot of panelists, and pretty much everybody has demonstrated that there are a lot of hurdles with regards to increasing the flow of financing to agribusinesses across Africa. I like to spend the rest of my time drilling down to 2 specific barriers to bridging supply and demand for agribusiness financing, and 2 case studies that have unlocked finance for our network of retail and commercial financial institution partners. First, collateral requirements and accounting principles. Second, agribusiness profitability and return on investment. So agri-SME businesses inherently have very different cash flow profiles and investment criteria than typical SMEs. Due to seasonality, high working capital demands, quick turnover needs, collateral representation to meet regulated financing needs is quite limited within the sector. This is further compounded by other internal process barriers within investment firms and banks and microfinance institutions, most notably IFRS 9 accounting principles, which do not allow biological assets to be counted as collateral. However, through blended finance and patient capital investments, in 2018, our portfolio launched dedicated co-guarantee vehicles to buy down regulatory collateral requirements for qualifying agribusiness firms. As we piloted and scaled this approach, we calculate roughly a 6.4 to 9.8 times leverage in bridging finance to agribusinesses. Of course, depending on the value chain, the loan purpose, and as Julia pointed out, where these ag businesses are located. So pairing this specifically with working capital lines of credit, we've seen this approach to be very significant in directly enabling SME finance to strengthen purchasing capabilities and supply chain functionality, further unlocking capital for last mile farmers below them. Secondly, as I said, agribusiness profitability and return on investment. A lot has been said on this today. Sally Africa and Dahlberg Advisors have completed their benchmarking assessments and are noting a 4 to 5% lower return in the sector. So clearly this represents a significant opportunity cost challenge for credit committees, investment advisory boards. Why invest in an agribusiness when an urban investment will have a higher return? But ultimately, if clients aren't profitable, then our financial institution partners will not be profitable and our portfolio will not be sustainable at the end of the day. So in order to first bridge this gap and second, ensure that interventions are not just protecting the investor, but actually benefiting the client. One case study, our financial institution Uganda, Opportunity Bank Uganda Limited, directly participates in the regulator-led agricultural credit facility. So as a pay-for-performance central bank rebate program, we've been able to offer agribusiness loans to qualifying businesses at a reduced interest rate by 2 to 3% per month. So as a result, we're seeing sub-market local currency financing rates made available at 6.5 to 10% interest annualized. And that's noting the current inflation rate of the Ugandan shilling is 6.15%. So I'm aware that recent critiques of the Bank of Uganda's agricultural credit facility have noted some longer term issues, and I would agree with many of the critiques. And sub-market financing is not a standalone solution by any means. But with regards to all agricultural financing, we do know that access to credit delayed is all but the same as credit denied. So we've been hard at work behind the scenes to increase agricultural business understanding at the bank, from the board level down to the credit officer. One of our key agricultural KPIs is loan approval turnaround time, the number of days from the submission of a credit application to its approval. At Opportunity Bank Uganda, we've seen this decrease from an average turnaround time of 60 days down to 4 days. And in the case of our focused mechanization portfolio with John Deere, this has grown even as low as 23 hours. So from our vantage, at the end of the day, we really are seeing major increases in our tier 1 banks' appetite for ag business financing and a significant increase in client demand for better optimized lending products. So Alice, I think looking at my clock, I'm going to put my comments on pause there. But I guess the maybe 15 seconds on bullish versus bearish, I don't think we have a choice. There's a lot of hurdles right now. COVID-19 specifically has really significant bearish implications for the market, but given that 60% of the remaining unopened arable land in the world is here in Africa, we need to invest in this space, and we need to ensure the doubling and tripling of food production that needs to meet the population demand in the coming years.
Tim, thank you very much indeed, and ending on a note which, you know, we just need to find a way to do this. I wanted to go back to a question that we touched on earlier with Thomas about any recommendations for small individual investors who might want to get into this space, who maybe have more of a focus on impact or perhaps more of a focus on long term potentially, but in any way in which there are vehicles that you would suggest could be for individual investors to get involved in African agricultural businesses. Should we come to you first, Julia?
Sure. I mean, I would say you have to piggyback on experienced teams. And so you don't want to be doing it yourself. You want to be working with those who are super experienced and have diversity in their portfolio. Us, Silver Street Capital. So
there's a retail option available for some of those for yourselves, or
no? So we're larger. So yeah, and but we do have
Absolutely,
co-investment opportunities open at the moment. It
Very
depends on the
good.
size that someone is
Yes,
looking for.
exactly. How small are we talking? Yeah. No, great. No, absolutely take the point that you need to be working with people who are experts in that field, and it's something you raised earlier about those investment committees really needing to be aware of the differences between different countries and focused on those opportunities and the risks. And Tim, where would you come out in terms of, is Opportunity International got opportunities for smaller investors as well?
So I would probably just start with a recommendation similar to what Julia was saying about local expertise. The further removed an investor is from its investee geographically, the higher your risk profile goes up, without doubt. So making sure that you understand your investee's business is critical before making any investment. So would strongly recommend making sure that as you're looking at investment opportunities, look as close as possible. The second piece is noting, a lot of firms right now in the market spend 30% of their capital on origination, identifying these investees. So, definitely make sure that you're doing due diligence as much as possible. To Julia's point, go ahead and make sure that you're partnering as much as possible to secure that investment. Because if that investment's lost, it's not just damaging the investor, it's also damaging the market and the investee as well.
Yeah.
So just a word of caution.
Yeah. Absolutely, no, such an important point. A question from Keith Polo, and this is particularly to an observation you made, Julia, about building in access to basic services, schools, healthcare, water, and so on. They do that, he says, at Mission Invest and see the benefits, but don't necessarily focus on smallholders. And they wonder what insights you may have from the experience of building those into investments that you could perhaps share.
So one example is we have an investment in quite a remote area in Zambia where there was a vehicle going every single day, driving 2 hours to get to the closest clinic. And there's quite a workforce on the farm, and so there were people who, either from the employees or their families, who wanted, not necessarily from workplace injuries, but who needed to go to the clinic, right? And so the business provided transport every single day, and it was like a stupendous waste of everyone's time. And so the business built a clinic and partnered with the government. Built a clinic. They now see 900 patients a month, and it's just been the most wonderful thing there. But I guess my point was that smallholders do need all these services in place in order for them to not have to stress about them and not have to think about them. Like, you don't want someone to have to walk all day in order to get poor healthcare and then be stressed about it, and then maybe lose a child because the healthcare wasn't adequate or something like that. Like, that's just terrible for everyone. And so to be really profitable at your business, which is, if you're a smallholder farmer, then it's agriculture, then yeah, you need all of those things in place. Did I answer the question properly?
No, you did, absolutely. I think it's interesting because it's sort of almost counterintuitive that you think it's an extra cost, but what you're saying is actually, if you're going to make the whole thing function, it's a necessary cost which actually will pay back, in the sense of you have smallholders who are actually able to do their jobs of generating income and getting their livelihoods without having to worry about their resilience. Yes.
Yeah,
yes.
And we've, sorry to add to that, we have done surveys because obviously we want to know what the outcome of our impact is. And the primary and secondary spends of smallholder farmers is pretty much always like education is always in there, healthcare, building houses. It's like you go to any country, this is like the kind of thing that doesn't really change. It's the same sort of thing, but they need those resources in order to spend that, and that all builds the local economy as well.
And Tim, perspectives from you on that in terms of where you think that the funding can go for that. I mean, we are looking at higher risk, lower returns perhaps in the sector, but this is a way to build returns rather than being a way to detract from returns, provided it's done in a way that's proportionate, I suppose. And it's difficult to get that right. But what's your experience in Opportunity International?
Yeah, so to Keith's question, ultimately, I think this is the same question that we ask ourselves on lifetime client value. So what is the investment that you're planning to make? What is the purpose of your firm, and what's your intended footprint? If you are going to continue to be working with the same group of smallholder farmers for 10 years, 15 years, then it makes a heck of a lot of business sense to make that investment and to make sure it's passed down, because there will be cost savings over time. When we look at it from the financial sector, the same with a bank financing smallholder farmers. We don't want them to change banks next year, so we would rather offer them a better product. So the same thing goes for agribusinesses, for DFIs, and for the sector as a whole.
Perfect, thank you very much. And a question from Mohammed Naeem. What do you think about the hypothesis that SME business and entrepreneurship skills are the biggest bottleneck in growth and access to finance in becoming gazelles, in Tom's terms? That's the first part of his question. So Tim, coming to you first for that one.
I would very much agree. I'm not sure I would agree that it's the biggest bottleneck, but it certainly is a significant one. It's one of the ones that was a runner-up in my 2 case study piece. We've been on our side partnering with development actors such as USAID on a seed systems program to specifically look at agri-dealer and seed firm training curricula to really look at increasing the capabilities of firms to, one, manage their business, but also secondly to manage the farmers that exist within the ecosystem with them. The second piece is really looking at, Alice, I'm told CASA was doing an ICT session before this. The functionality of digital technology and being able to relieve the pressure of that bottleneck for small agribusinesses is monumental. And the ability to collect data on the back end of those ICT systems is incredibly meaningful in the financing space in terms of automating even credit scores where there is no regulator to do that for us.
Yeah, no, absolutely. And your perspective, Julia, on that that entrepreneurship and the skills, the business skills being such a big barrier, and is that you recognise that as a key part of it?
Yeah, absolutely. I mean, that's the base, right? So if you have the skills and the knowledge, then you're going to make good decisions and you're going to do things correctly. But if you have all the knowledge and skills in the world and you don't have the inputs, then it just, and so it's hard to, I mean, how do you say, well, this is the most important thing? Because actually you need everything in order to work properly. So you need to have that training, you need to have the inputs on time. Tim was saying about credit, like delayed credit is as good as no credit. It's the same with inputs. Like if you don't have your inputs on time, you lose tons per hectare as the days go by. And so training is absolutely critical. But yeah, it is integrated into the whole picture.
Yeah. And that triggers another thought around, and it's reflected in a question around, you mentioned that one of the questions was, should we be focusing on investment in the entrepreneurs and the smallholders themselves, or in the infrastructure surrounding them? And your response, both of you, I think, was, well, there isn't a choice, we have to do both. And that's part of the same, I suppose, part of the same point, isn't it, where many of the interventions that we make are complementary and have to be done as a whole. Do you see investors being interested in one or other in terms of that risk and return and the collateral perhaps as well? Is there a part of that that's easier at this stage for investors to get a hold on, do you think, and sort of see the risk return profile of a certain part of the value chain or a certain part of the infrastructure support more easily giving returns? Tim, what's your take on that one?
It depends. Depends on the value chain, depends on, as Julia said again, the geography, the location, but it also depends on the investor gearing. So what are you actually trying to do? What are you trying to make with that money? And that will really focus unique skill sets to essentially develop a higher return for that investment. So I think increased levels of specialization will actually continue to increase the returns for investments into agribusinesses and SMEs.
Great. Yes, absolutely.
Very grateful for Tom's work in the segmentation that he's done. Really looking at how do we segment one agribusiness from another, because that's absolutely critical.
Yes, yes. And your point, Julia, about even in different poultry sectors in different countries, you know, that the risk profile will be completely different. So it needs that really specific look at individual projects, individual companies, individual investments. Very difficult to generalize. That's?
Yep, absolutely. And so, like, for example, you might, and I think that, so there's like a risk return, but there's also, in that return, there needs to be an impact return. And sometimes someone will want a much higher impact return, and that'll be much more important to them. And so then they'll be biased in what kind of investment that they would make.
Yes.
Yeah.
Interesting, and that picks up a little bit about your point on accounting principles, I guess, Tim, where we're just not thinking about those things in terms of what we're bringing into the calculation of risk and return efficiently in the way that we analyze projects. Would you like to expand on that a bit more?
You know, there are a lot of regulations, and there's a lot of assumptions from investees that the investors just don't want to do this. And so I think one of the critical kind of pathways to resolving this tension that Tom has been mentioning in this report is better visibility and transparency on both sides. You know, for us, it's really important that clients understand what's happening in the back rooms of a financial institution as much as possible. But there are regulations that exist on a country-by-country basis, which really do inhibit the ability for regulated financiers to actually lend. So, you know, we're really doing our best to make sure that we're mapping our own constraints alongside mapping clients' constraints. And the same goes for that comment about segmentation. Investors are different, clients are different. There's a lot of work that needs to be done in terms of proper matchmaking. And I think Agra has invested heavily in this, even in this platform with the deal room. So making sure that the right people are talking to the right people at the end of the day.
Yeah, absolutely. Excellent. Keep the questions coming. Another question, I'll ask you first, Julia. If you could wave a magic wand and solve one issue, what would it be? That's a tricky one, perhaps.
No, it would be education. So much is built on education. I mean, smallholders needing to be able to count yields or just account for their own productivity, you need to be able to account. You need to be able to write. You need to, in order to really properly do it, to track what your productivity is. There has been, I mean, there was some the Bill and Melinda Gates Foundation research that showed that increased education in women reduced number of children, but increased the wellness of those children, and ultimately increased how much money all those households had. And that is definitely one of the things that, I mean, smallholder farmers are subject to is too many children and having so many mouths to feed. Yeah. So yeah, education. That would be my one waved.
And Tim, would you have a particular one you would flag? Your magic wand would change?
You know, 6 months ago, I probably would have sided with Julia on education in terms of the critical nature of it. But given the times that we're in now, you know, there's no silver bullet for agribusiness financing for smallholder farmers. But if I could wave a wand and wind the clock back 6 months and remove COVID-19, that would be the wand I would wave, because of what we're seeing happening to agribusiness liquidity. It's absolutely evaporating. The ability to maintain jobs for rural employees, and many of the agribusinesses that are already getting credit, their credit scores are getting just decimated through this pandemic. That's in addition to all of the public health crises and the economic downturn and school closures, to Julia's point as well.
Yes, yes, yes. Gosh. A question from Kapanda Piri. Hi, I'm a small-scale farmer, and I've come to notice that one of the major factors to failure is the tools we're using, in particular the hoe. I've researched and come to the conclusion we need to modify the hoe. How do I go about sourcing seed capital to build a proof of concept on a wheel hoe? Tim, why don't you go first on that one? Is there a source that you could go to? Are you aware of places that would be open to that?
Yeah, so I very much agree with Mr. Piri's statement there. Daiborn Chibonga, who's one of the regional agro managers based out of Mozambique now, he had a phrase that was one of my favorites, that the short-handled hoe is a weapon of mass urbanization. So anything that we can do to really look at relieving the drudgery within small-scale agriculture, increasing productivity, 100% on board. So I would recommend to Mr. Piri that, depending on which country, I'm assuming either Zambia or Malawi based on your surname, there are a lot of investment facilities specifically targeting technology and innovation. Feel free to reach out to me on the deal room for either of those countries, depending on where you're based, and I'd be more than happy to connect for early stage and startup proof of concept.
Wonderful, thank you very much for that. Anything to add to that, Julia? Do you in your markets, are there particular places to go?
No. Yeah, I don't. No, I think
that's fine. No, it was a very comprehensive reply from Tim anyway. I wanted just to move to the point about the collateral as well, because that was something that came out very strongly from your prioritization, Tim. Would you talk a little bit more about how you see that? Does it have to involve legal intervention, regulatory intervention, or could it be something that the banks take on themselves and move forward without that public sector intervention?
Depends on the regulator, but we found it to be quite helpful, and beyond that, also a significant factor when it comes to inclusive financing. What we do know from client assessments and surveys is that women-led business and firms in general tend to have less in collateral. We know the same when it comes to youth-run agribusinesses and firms, led and managed. So there's a lot of ways in terms of how to manage that. However, I think we should give a little grace to the financial institutions who, the board of a bank has very significant expectations when it comes to returns. So there's a lot of different interventions. In our case, we've been using private capital and equity to co-guarantee as collateral alongside the financial institution.
Excellent. And I suppose picking up something which was similar around you mentioned tax incentives, Julia, as a key part of trying to drive further investment into these smallholder activities. How do smallholders or other associations lobby for that? How do people try and be proactive in trying to engage governments in that space, do you think?
Mm-hmm. Through groups of smallholders. So, for example, in Tanzania, there are things called agricultural marketing cooperatives, agricultural marketing cooperative societies, and so they really have a voice with local government, and government have actually asked them to form into groups and market through those groups. My thought with that was really with developing larger businesses. And so, okay, bring your private investment into this country, and it's more of a. I was thinking of that for larger businesses. Yes. Yeah, would absolutely fit with smallholders as well.
Okay, perfect. And then I suppose those larger businesses might then be able to engage with the supply chain, and we'd get possibly some results through that intervention. Yes.
Right. So that would be the whole idea, right? Is building the business and building smallholders into businesses.
Exactly.
To provide markets for smallholder farmers.
Yeah. No, fantastic. So the tax incentives at that larger level, but that would really help to drive the supply chain through.
Right. Yeah. We did see one example. Sorry, if I just may give one example. We did see one example in Tanzania where. In a poultry operation, there was a tax put on poultry feed, and that directly disadvantaged smallholder poultry farmers who were purchasing the feed. And the second that the tax was lifted, and the poultry industry rallied to get that tax lifted, and as soon as it was, then feed sales went up. And then the whole industry lifted. Right?
Unintended consequence of that. Yeah, really interesting. Very final question to you both, and it is about COVID, because you both mentioned COVID as an issue. how do you suggest that the pipeline can be supported through COVID? They mentioned the demand and the supply pipeline, the demand for investments and the supply of finance through this very tricky, very challenging time. Tim, first of all, things that you've done to adapt and try to support your pipeline.
Yeah, it's been really difficult in terms of the investment environment as a result of this. Over the last 6 months, specifically our agribusiness portfolio risk profile has doubled. It's been just devastating in terms of the clients, in terms of the portfolio as well. But from our side, there's a lot of partnerships that are available in terms of better understanding first the impact on the client level. So we partner with Microsafe Consultancies to analyze business disruptions across our portfolios in Ghana and Uganda. And we found quite a lot from that, and it really informed our strategy. Additionally, last year we had the privilege of running focus group discussions with farmers in Mozambique that lost their livelihoods to Cyclone Idai. And their report, looking at the similarities, that 6 months after the floods receded, the farmers and agribusinesses that rebuilt reported that flexible debt management, grace periods, and savings accounts were the major reasons for their ability to start again. So we've developed our response to mimic that. We've injected capital to directly pay for lost interest income at the financial institution level so that the portfolio can reschedule loans at no additional cost to qualifying SMEs.
Fantastic, thank you for that. And Julia, just a brief comment on that from your side.
Yep, absolutely. So we're very lucky that we've had very few cases, actual direct cases in our operations. But what it has done, what COVID has done, is that inputs have often been delayed. And so like some of our commercial operations are short of some inputs, and also trainings to smallholder farmers, so group meetings have been stopped, and so you have to find alternative methods to provide that training. So whether that's through radio, through SMS, through definitely alternate. I mean, Zoom doesn't get to remote parts of Zambia. Maybe we should go and live in remote parts of Zambia. But and so switching to different training opportunities and keeping your market going so that those smallholders still continue to have that market is really critical.
Wonderful. Well, thank you both so very much. We're coming to the end of our time, and you've really helped to provide some real flavour around the themes in the research based on your deep experience, and much appreciate all of the insights you've shared. As we mentioned, this is recorded, so there'll be the recording available on the CASA website at casaprogram.com, and the research itself is available on the website as well. So please do go and check that out, and I think both of you will have fed into that research, so your insights will be reflected in that as well. Just wanted to close by saying that there's also some CASA Agribusiness Breakthrough webinars, which are going to be every Wednesday morning, the first Wednesday morning of every month, where that will showcase some additional CASA research and analysis. And so you can register on the events page of the CASA website. And finally, thank you to the organisers at AGRF, also to Simon Calvert and Liz Kirk of FCDO. And thank you very much indeed to Tim and Julia for your presentations and fielding all of our questions. And thank you all for listening. Thank you.
Cool. Thanks very much.